Most people think the path to more money is learning to trade better. Better entries, better chart patterns, better instincts. But Jim Simons built one of the most famous fortunes in finance by doing the opposite. He tried to remove trader skill from the system entirely. In this video, you'll learn 2 lessons you can actually use: how to replace intuition with process, and how to replace opinions with data. And there's one decision that makes the whole approach work. Most investors can't copy it, and I'll explain why. Why traders fail, and what Simons replaced them with. Here's the uncomfortable truth. Trading is a decision-making job done under constant uncertainty, with money on the line and feedback that's noisy. That environment is basically designed to trigger predictable human errors. The thing most people miss is that you don't have to be bad at trading to lose. You just have to be human. Under volatility, people get overconfident after a few wins. They get timid after a few losses. They start seeing patterns that aren't there. And they become addicted to narratives because stories feel like control. If you've ever bought because this looks ready to break out, then sold because the market feels shaky, you already know what I mean. Those aren't rules. They're emotions wearing a suit. Now, what does trader skill usually mean in the real world? It's discretionary calls. It's interpreting charts and calling them support and resistance. It's having a macro view. It's reacting to headlines. It's saying, I've got a feel for this, and then adjusting mid-trade because the vibe changed. And even if you're right sometimes, the hidden cost is the repetition. A small mistake, repeated often, compounds. Not just financially, but behaviorally. Because each trade trains your brain. You start rewarding activity instead of accuracy. You start believing that being busy is the same as having an edge. That's why trading feels productive while it quietly bleeds you. So Simon's contrarian move wasn't, let's build a better trader. It was, let's replace the trader. Instead of prediction and opinion, he prioritized pattern recognition and measurement. Not in the vague way people use those words online. Actual testing, actual counting, actual rules that can be checked. What this means is you stop asking, what do I think will happen next? And you start asking, what tends to happen after X, often enough that it's worth acting on? If we control risk, that mindset shift matters, because it changes the hiring logic too. If your entire strategy depends on discretion, then you hire personalities. You hire confidence. You hire people who can sell a narrative. You hire the kind of person who can make a call and defend it. But if your strategy depends on research, you hire different brains. You prioritize people who can test ideas, break ideas, and throw away ideas quickly. People who are comfortable being wrong on the way to being precise. People who don't need to be the hero of the trade. Now, here's where most people mess up when they hear this. They think no traders means nobody debates anything. The opposite is true. The debate just moves issues earlier in the process. The argument isn't about whether to buy today. The argument is about whether the hypothesis is real, whether the definition is clean, whether the test is honest, whether the edge survives when conditions change. Then, once that work is done, the system executes. And the team defers to the model. Not because the model is magical, but because the alternative is improvisation. Improvisation is just discretion in a different outfit. And discretion is where ego sneaks in. This clicked for me when I realized the anti-trading framing. You're not trying to be right today. You're trying to be consistently slightly right, often without blowing yourself up when you're wrong. That's a very different goal than most retail trading content teaches. Most of that content sells you on being a sniper. Simon's approach is closer to being an insurance company. Small advantages repeated with tight risk control. Now, what can you do with this realistically? You don't need a hedge fund to apply the principle. You need to identify which decisions you can systematize and then remove the rest. For most investors, that means you can write rules for entries and exits that are based on your time horizon. You can set rebalancing rules. You can set risk limits like position sizing and maximum loss thresholds. You can decide in advance what would make you add, reduce, or do nothing. And do nothing needs to be a rule too. Because the biggest leak in most portfolios isn't the choice of assets. It's the emotional override. The just this once decision that turns a plan into a reaction. Common mistake. People try to copy the vibe without the discipline. They use quant buzzwords, backtests they don't understand, and complicated indicators, but they don't build constraints. They don't write rules they'll actually follow. They don't separate research from execution. Once you accept no intuition, the next question becomes obvious. If we're removing the trader, what does the system actually run on? The system runs on discipline, not brilliance. The reason models win isn't because they're always smarter than humans. It's because the inputs and the execution stay consistent. Humans change their standards mid-game. Models don't, unless you let them. Start with the data principle: garbage in, garbage out. If your data is messy, your conclusions will be fantasies with spreadsheets attached. What this means is the edge is often in definitions. How you label a signal, how you measure a return, how you account for costs. If you're sloppy there, the math can't save you. Now, let's look at the research loop you can actually copy. You form a hypothesis, not a prediction. A testable statement like, after this condition, the odds shift slightly. Then you test it on historical data. Then you stress it against different market regimes, because the market changes character. If the edge disappears when conditions shift, you don't negotiate with it. You cut it. That's the part most people skip. They find one backtest that looks good, then they fall in love. But a real research culture is built to destroy ideas fast. Once you have something that holds up, you design the edge the way an engineer would. You aim for repeatable probability advantages, not heroic bets. You're not trying to be right with confidence. You're trying to be right with frequency, while keeping losses survivable when you're wrong. Think about it like planting a garden. You don't bet your entire harvest on one seed and 1 week of weather. You spread your planting, you control the soil, and you accept that some days won't cooperate. The win is the process that keeps producing. That leads into portfolio logic. Instead of concentration driven by conviction, you run many small bets with controlled risk, and you measure constantly. The thing most people miss is that diversification isn't just own more stuff. It's structuring your exposure so one mistake doesn't erase a year of progress. And then comes the part that makes the whole approach work: execution discipline. Rules for when to trade. Rules for how big to trade. Rules for when to stop. That last one matters because losses don't just hurt your money. They tempt you into revenge decisions. A no-override mindset is basically a shield against your own psychology. If you intervene emotionally, you're reintroducing the exact risk you tried to remove. So the standard becomes, either you trust your process, or you admit you don't have one. So what can you copy ethically and realistically? First, build a written rule set for buys, sells, and rebalancing. Written means you can't rewrite it in your head after a bad week. Second, pre-commit risk limits. Position sizing is the simplest lever. Decide what percentage you'll put into any one idea, and decide the conditions where you'll reduce exposure. You don't need to be fancy. You need to be consistent. Third, track decisions. Not just performance. Decisions. Write down why you acted, what rule triggered it, and whether you followed the plan. That's how you separate skill from luck. Common mistake: overfitting. People build a perfect backtest that only works on the past because it accidentally memorized the past. Keep your rules simple enough that they're robust, and humble enough that you expect rough periods. The key takeaway is simple. Wealth compounds faster when you replace opinions with rules and protect yourself from your own reactions. If you want the next layer, how to build a personal no-override investing system without day trading, watch the next video and subscribe. What rule do you need most? Risk limits, rebalancing, or decision tracking? Tell me below.